FHA mortgages have become increasingly popular among homebuyers in today's market, and there's many reasons as to why. In this video, I'm going to touch on some of the key differences between FHA mortgages and other loan types and why I feel they've grown in popularity. So let's start with the most obvious, low down payment. So FHA mortgages allow for a low down payment, and believe it or not, you can actually get an FHA mortgage with as little as $100 down. That's right. Now, the caveat to that is that the property needs to be a HUD REO, meaning real estate owned, meaning it was foreclosed on by HUD from an owner who had an FHA mortgage. But if you go on the HUD Home Store website, which is hudhomestore.gov, you can actually search properties specific to this type of FHA loan program, and any property listed on there is eligible for only $100 down, which is pretty incredible. Now, outside of that, you can buy a regular property, meaning a property that's not a HUD REO, with as little as 3.5% down, which is pretty awesome. Purchase a home as long as it's your primary residence. It does not need to be your first home you've ever owned. That's a common misconception. FHA loans are not just for first-time buyers. However, they are specific to those buying a primary residence, meaning a home you're going to live in year-round, right? But they allow for a low down payment. Like I said, $100 if it's a HUD REO, 3.5% down if it's a regular property that you're purchasing. Now, they also allow for lower credit scores than other types of loans. As a matter of fact, you can go as low as a 500 credit score on an FHA loan. Now, the thing is, most lenders will not go that low on the credit score, although FHA loans allow for it. Most lenders require at least a 580 credit score, but that's still pretty low to be able to qualify for a mortgage, considering conventional mortgages, another popular type of loan, require a minimum credit score of 620. Now, another benefit of FHA loans and something that makes them more popular is the fact that they have shorter waiting periods after major credit events before you can actually qualify. So if you've had a Chapter 7 bankruptcy, for example, you only have to wait 2 years to get an FHA mortgage versus 4 years on a conventional mortgage, as one example. They allow for higher debt-to-income ratios, meaning the amount of money you make monthly compared to your monthly expenses, including the new property you're buying. So most conventional mortgages will not go above a 45% debt-to-income ratio. Now, there are situations where you can go as high as 50%, but that's definitely the exception, not the rule, right? In most cases, you're capped at 45% debt-to-income ratio on a conventional mortgage. However, FHA mortgages allow you to go as high as 57%. That's a pretty substantial difference in debt-to-income ratio, and it can make a world of difference in your purchasing power. One thing that I would consider to be a little bit of a negative with FHA is that their maximum loan amount that they allow is lower from county to county than it is for a conventional loan. Now, any type of mortgage, whether it be conventional, USDA, FHA, is going to have maximum loan amounts based on where the property is located. They vary from county to county, and they change from year to year. The maximum for FHA is lower than that of conventional. Now, you have a fixed cost of mortgage insurance, which makes these loans very attractive. So if you're buying a property, let's just say you're doing a conventional mortgage, you're putting less than 20% down. You probably know, or you may know, that you have to pay monthly mortgage insurance, PMI, private mortgage insurance. On conventional loans, the cost of that mortgage insurance varies based on multiple things. Just like an interest rate, the credit score plays a part, the number of borrowers, the property type, the debt-to-income ratio, amount of money you're putting down. All of those things will determine the cost of mortgage insurance on a conventional loan. What's nice about FHA loans is that the cost of that monthly mortgage insurance is the same for everyone, regardless of your credit score. It only varies marginally depending on your down payment. So if you're putting 3.5% down on a property using an FHA mortgage, you're paying 0.55% mortgage insurance rate. If you're putting 5% or more down, it drops to 0.50% mortgage insurance rate. Now, that's fantastic, but a negative dealing with that mortgage insurance is that if you're putting less than 10% down getting an FHA mortgage, you're going to be required to pay that mortgage insurance for as long as you have that FHA mortgage. Now, there's nothing stopping you from refinancing out of an FHA mortgage into a conventional mortgage. Let's just be clear on that. But for as long as you have the FHA mortgage, you are going to be paying that monthly mortgage insurance, assuming you put less than 10% down. If you put 10% or more down and you keep that FHA mortgage for 11 years or more, that mortgage insurance will fall off after 11 years. Now, a negative with FHA is that you have what's known as a upfront mortgage insurance premium, which is equal to 1.75% of your loan amount. So we call your loan amount 96.5%. of the sale price, well, you're going to multiply that by 1.75%, and that it's called your upfront mortgage insurance premium. That can either be paid in full at closing, which never happens, or it can be rolled into the loan. So technically, when you get an FHA mortgage, you're really borrowing more than 96.5% of the purchase price. You're actually closer to 98% of that purchase price as far as your loan amount is concerned. And you may see loan disclosures and documents where you've looked at and say, I don't understand, why is my loan amount higher than expected? It's because you have a base loan amount, which is the 96.5% of the sale price, and then you have the gross loan amount, which includes that upfront mortgage insurance premium rolled in. Now, why do I believe these loans are become more popular? Well, first off, I feel like, for one, the rates are better. So FHA loans, because they're less strict on credit score, less strict when it comes to the property you're purchasing, down payment amount, well, the interest rate is going to be better because there's less adjustments made to those rates when qualifying. So most people are going FHA, or a lot of people, I should say, are going FHA if they have a credit score that's below 700, because the rates could be a full percent lower than what they're able to obtain if they're trying to get a conventional mortgage in comparison. So these are things you want to keep in mind when you're shopping mortgages. I think FHA is a great option, especially if you are that person who's looking for a lower down payment and you don't have the best credit score out there, because it's going to save you money on the interest rate, it's going to save you money on the monthly mortgage insurance, and of course save you money in your out-of-pocket when you're buying the home. And on top of all those things that I feel are great when it comes to FHA financing, they actually allow for a larger seller credit than their conventional loan counterpart. Normally, if you're getting a conventional loan and you want to try to negotiate a seller credit, meaning money to use toward your closing costs or a temporary rate buy down or just buying the rate down in general, whatever it is, money from the seller to help you pay for things. If you're putting less than 10% down on the property, you can't get more than 3% from the seller if you're getting a conventional mortgage. However, on an FHA loan, even if you're putting only 3.5% down on the property, you can actually receive up to 6% from the seller. So that money goes a lot further for you. There are plenty of times that we've done FHA mortgages for buyers where they're only coming to the closing with their down payment funds, meaning the 3.5%, because you're getting enough of a credit from the seller to cover all of the costs that come along with buying. And if you're not familiar with the fact that there are costs that come along with buying outside of your down payment, make sure to subscribe and check out my video where I break down all the costs you incur when buying a property. I walk you through it step by step, itemized out, so you have a full understanding of what you're getting into. But with FHA, there are times where you get enough of a credit to cover all those costs. So you're getting into a property, just the down payment, which is absolutely amazing. So now that you have a better understanding of FHA loans, I hope you have more confidence in becoming a homeowner. If you have any questions about your specific scenario, please leave a comment below. I reply to 100% of the comments left on my videos. And make sure to subscribe if you'd like to continue educating yourself on all things mortgage and real estate related.